Stop. Look at the chart now. Silver is in vertical launch. It just outpaced gold by a factor of 3 this month. This is not a win. This is the alarm bell ringing. This is the silent metal screaming panic. It is the systemic logic engaging its final phase. Every major collapse in modern history started exactly like this. The quiet asset makes a violent move. It happened in 1979. It happened again in 2011. History is not merely repeating. It is escalating. We are watching the exact terrifying pattern lock into place right now. The price surge exposes one undeniable, hidden truth. The green transition is not safe. It has turned the silver market into a permanent, unavoidable demand trap. The supply chain is now a live fuse. The supposed safe haven is being rapidly consumed by industry. This is physical reality colliding with political fiction. The fragility is absolute. You are watching the end of the paper price system. The time for warning is over. The price movements we see today are a sharp echo of a much darker, much more controlled past. To truly understand the trap, you must look beyond the daily price ticker. The systemic logic driving these cycles is always the same. It is the widening, lethal gap between paper promises and physical supply. The last time this mechanism engaged with this force was the late 1970s. That period is not just history. It is the exact blueprint for our current collapse. The late 1970s saw hyperinflation explode. This followed the final, inevitable decoupling of the dollar from gold in 1971. Trust was completely gone. People, smart money, sought refuge in hard assets. What followed was a manipulation attempt that became a legendary systemic stress test. They saw the end coming. The Hunt brothers recognized the inherent, brutal scarcity of physical silver. They began accumulating massive, quiet stockpiles. This was their escape plan. Official COMEX data from that period is damning. The Hunt's position by early 1980 was estimated to be over 100 million ounces of physical silver. That number should terrify you. It was a massive fraction of the world's annual production. They understood the pattern. Physical supply simply could not keep up with the mountain of paper contracts. The consequence was locked in. It became mathematical. By January 1980, the price of silver skyrocketed. It went from around $6 an ounce to an incredible, unbelievable peak of $49.45 an ounce. This was a 724% surge in just over a year. The volatility itself was proof of the market's deep, permanent fragility. This parabolic move was not sustainable. But the following crash was not a natural correction. It was an engineered, cold-blooded intervention. It was designed to save the system from the truth. The official response exposed the true mechanism of control. The regulators and the exchanges panicked immediately. The COMEX abruptly changed its own rules. They mandated liquidation-only trading. This is the infamous Silver Thursday. The system always shows its hand when threatened. They would change the rules instantly. They would do it mid-play to preserve the paper structure at all costs. Physical reality was deemed too dangerous for the established financial system to survive. The price of silver crashed violently. It fell by over 50% in 4 trading days. This was not the end of the history lesson. The systemic logic had been proven correct. The paper market could be ruthlessly manipulated. It could be contained to prevent the physical escape. But the pattern, the recurring mechanism of scarcity, remained. It was now coded into the system's DNA. The paper contracts were saved. The integrity of the entire market was sacrificed permanently. Fast forward almost 2 decades to the 2000s. The same pattern began to build. But this time it had a new, more sinister disguise. Industrial demand. This is the key difference. Silver is consumed. Unlike gold, which is mostly held, melted, and held again, silver is used and destroyed. Over half of all silver mined goes into permanent, non-recyclable industrial uses. It is burned up. It disappears forever into electronics, into solar panels, and into complex medical devices. This is the industrial demand trap being set. This demand is not for investment. It is for total consumption. The early 2010s saw the next violent echo. This was between 2008 and 2011. Amid massive, unchecked central bank quantitative easing, the deliberate, coordinated debasement of the currency, investors again recognized the systemic risk. They remembered the hard lesson of the 70s. Physical metal was the only logical antidote to political, debt-based money. The price climbed from under $10 an ounce in 2008 to a shocking peak of nearly $50 an ounce in April 2011. This 400% surge was less about a single entity cornering the market. It was pure, untethered demand meeting dwindling physical supply. It was a genuine systemic stress test. It tested the supply chain itself. The paper contracts were stretched again to their absolute logical limit. We have a truly shocking number from that 2011 period. The total COMEX registered inventory for silver was only around 45 million ounces at the time of the peak. That number should send a deep chill through you. The entire global paper structure, billions in value, was resting on a physical base. A base smaller than a few months of total global industrial consumption. The system was running on nothing but faith and fractional physical reserves. The system's response was brutally predictable. It was the same containment mechanism used in 1980. Margin requirements were raised repeatedly. They were raised multiple times in rapid succession. This is the quiet, legal violence of the exchanges. By suddenly increasing the capital needed to simply hold a position, they forced speculative contracts to be liquidated. They choked off the physical demand. The pressure was relieved by a simple mathematical change in the cost of leverage. Silver prices collapsed immediately, dropping over 30% in just 1 week. The official narrative was simple: profit-taking. The truth is far darker. It was a forced liquidation designed to preserve the paper-to-physical ratio. The system absolutely cannot allow the true price of physical metal to be discovered by the market. If that price discovery is allowed, it instantly exposes the massive, unfixable fraud inherent in a debt-based fiat currency system. The mechanism is always the same. When physical reality becomes too dangerous, the paper rules are changed by those in power. This repeating pattern is the very core logic of systemic fragility. In the 70s, it was runaway inflation fear. In 2011, it was the aftermath of financial crisis and unprecedented central bank intervention. Today, it is both of those things. And it is amplified violently by the unrelenting, non-recyclable industrial consumption. We are entering the final endgame of this pattern. The price surge we are observing right now is the sound. It is the sound of the industrial demand trap beginning its final, inescapable closure. Look closely at the data right now. The historical pattern is not just rhyming anymore. It is accelerating. It is escalating. The systemic logic is being driven harder than ever before. It is pushed by a new, irreversible political force. The global, desperate push for so-called green energy. This is how the industrial demand trap is now fully exposed. Silver is the single most critical, non-substitutable element in the production of solar photovoltaic cells. A single solar panel needs only a small amount of silver. But the sheer volume of panels being deployed globally has turned this demand into a geometric impossible curve. This is an unavoidable fact. The political promises are mathematically impossible to deliver without this metal. The International Renewable Energy Agency, IRENA, projects a staggering, massive expansion in capacity. The Silver Institute has documented the total, crushing global demand. In 2023, industrial consumption alone accounted for over 600 million ounces of silver. That is a truly shocking and terrifying figure. It represents well over half of the entire global supply. Most critically, that silver is permanently consumed. You cannot recycle it economically. It is gone forever. This consumption rate is the core of the coming doom. Here is a shock number you cannot afford to ignore. The Silver Institute forecasts that silver usage in solar panels alone will hit an astonishing 185 million ounces this year. This is a dramatic, forced increase in just a few short years. That single number should keep every serious market analyst awake all night. This establishes a floor under the price. A floor that is structurally incapable of falling. The demand is not elastic. It is mandated by global political policy and subsidy. The mining supply is completely stagnant. It cannot keep up with this politically engineered consumption. Global silver mine production has been relatively flat for a decade. We are not finding massive, new, high-grade deposits. The low grade of new or means higher costs. It means more energy, and it means less physical yield. The growing deficit between supply and demand is widening every single year. This is the cold, logical consequence of systemic overconsumption. Last year, the official global silver market deficit exceeded 140 million ounces. This is the third consecutive year. 3 years of a significant, crippling deficit. A deficit this large, sustained over years, is mathematical proof. It proves that the entire system is consuming its physical reserves. The stored supply, the final buffer, is being drawn down simply to power the political transition. This is an unsustainable trend. It is not a temporary blip. It is a one-way trip to a supply crisis. The current price surge is brutal. It has seen silver outpace gold by a factor of 3x this month. This is a direct, violent reaction to this structural reality. Smart money is seeing the systemic logic. The industrial demand is effectively functioning as a form of non-stop central bank buying. Except it is not a bank with unlimited paper. It is the entire global economy consuming a finite, physical asset. The paper market structure has become more fragile than at any point in modern history. The total registered COMEX inventory for silver has been steadily, quietly declining. It is a slow, methodical bleed. As of this quarter, the registered inventory is hovering near a critical 30 million ounces. Compare that number to the 45 million ounces they had in 2011. Compare it to the 100 million ounces the Hunts alone controlled in 1980. This is the final, undeniable proof of systemic stress. The physical buffer is disappearing for good. The paper-to-physical ratio has become completely absurd. For every physical ounce truly held in reserve, there are now hundreds of paper contracts claiming ownership. The entire structure is built on one simple, fatal assumption. The assumption is that no one will ever demand their physical metal at the same time. The industrial demand trap means that large-scale users must demand the physical metal every day. They demand it to keep their production lines running. The supply is already spoken for. Yet the paper contracts keep expanding. This is the exact recipe for a violent, catastrophic final repricing. The systemic logic is simple and cold. When the music stops playing, there is only one chair remaining. And that chair is physical. The industrial demand trap guarantees the completion of the historical pattern. Cannot be avoided. When the registered inventory falls to a critical, non-recoverable level, the market's price discovery mechanism will simply break. The consequence will be a vertical, final price move. A move that the exchanges, even with rule changes, cannot stop. The systemic stakes are too high. The industrial demand is too real and too immediate. When this final squeeze comes, it will not be driven by a speculative family. It will be driven by the absolute, non-negotiable physical needs of the global energy and technology sectors. They will be forced into a bidding war. They will pay any price to maintain their production lines. The price of silver will not just rise. It will become non-linear. It will detach completely from the paper price. The result of this repricing is a complete, irreversible loss of confidence in the entire paper structure. Imagine the global implications. A critical, irreplaceable industrial metal, the backbone of a trillion-dollar industry, suddenly becomes unavailable at the official paper price. The fear will not be speculative this time. It will be existential for global industry. This event will trigger a mass, desperate flight into gold and other hard assets. But the initial, most violent move will be in silver. This is due to its terminal scarcity and its crucial industrial consumption. The volatility will be historic. The exchanges will raise margin requirements to truly infinite, impossible levels. They will deploy every single containment mechanism they used in 1980. They will use every trick from the 2011 playbook. But this time, the structural demand is non-negotiable. The squeeze will not be relieved. It is a permanent, structural squeeze. It has been coded into the new global economic structure by political mandates. The collapse of the paper price structure will expose the massive, unfixable counterparty risk that everyone has ignored for decades. The major banks holding these gigantic paper short positions will face catastrophic, immediate losses. This is the precise point where the systemic dominoes begin to fall. A failure in the critical silver market could cascade instantly into the broader financial system. It proves once and for all that the quiet, consumed metal is the most potent, most accurate canary in the systemic coal mine. This is the ultimate, terrifying expression of the systemic logic. The political promise of a clean energy future has created an immediate, irreversible mathematical consequence. They did not factor in the physical, hard cost. They created a permanent, non-stop demand that cannot mathematically be met by a stagnant, declining supply. This is not a risk. This is a cold, hard certainty. The system has self-coded its own final, inevitable failure. This video explains historical and economic systems. It is informational, not financial advice or price forecasting. We have analyzed the brutal blueprint of 1980. We have broken down the systemic stress test of 2011. And now we are watching the industrial demand trap close the loop for the last time. Silver is outperforming gold by 3x this month. This is because the physical supply is mathematically incapable of meeting the politically mandated, non-stop demand. The final consequence is already locked in. The systemic stress is now becoming visible to anyone who chooses to look closely. Stay vigilant. Stay informed. The game is nearing its mathematical conclusion. Subscribe and join the community that truly understands the recurring mechanism hidden behind the daily noise. The promise is political. The consequence is mathematical. No one escapes.